So introduction, what is Forex? Forex, also known as FX, which is foreign exchange, is the global market that allows the exchange of one currency for another. It is the largest financial market in the world with volume of about $5 trillion. Or in a simpler term, we all know about who they call Bureau de Change. Aboki, Bureau de Change, they are simply foreign exchange traders. If you do business with those Malam or Aboki, you are a Forex trader. You are engaged in the business of financial currency exchange. In a simpler term, Forex trading simply means the buying or selling of one currency with another. So it's just like you want to travel abroad out of Nigeria. Before we go into the Forex market itself, let's understand what the Forex trading is about. Let's say you want to travel out of Nigeria and you know that the currency they spend in foreign countries are different from what you spend in Nigeria. In order for you to do business or do anything in that country, you need to exchange your naira to currency there. For example, the United States, you need to exchange your Nigerian naira to dollar for you to be able to do business. So that's basically what the Forex trading is all about. But in this particular business of trading, everything is online. So what we do, we are not trading because we want to travel out of Nigeria. We are not trading because we want to go anywhere. We are simply trading to make money. So imagine just like the Aboki Bureau de Change we used to illustrate, they trade currencies and they have their commission for every year they trade. Every amount of currency they buy or sell. That's the same thing we are doing here. But this our Forex market, everything is done online. You're buying, you're selling, everything is done online. There is no need of seeing the physical money or anything. Just register and then you're good to go. You trade when price is low or high, you make money, you buy and sell. That's the Forex trading simpler terms. So as we go further, you learn more about this market. So what is traded in the Forex market? Simple answer is money. Money is what is traded in the Forex market. Yeah, it is the simultaneous buying or selling one currency with another. How do you get started in the Forex market? So what do you need to become a Forex trader, to call yourself a Forex trader? Forex trading is as simple as buying and selling. You buy a currency, you sell it. You buy a currency or you sell it, or you sell another currency. So like every other business, there are principles and rules that guide them. You don't just do it because the job you do literally is just to buy and sell. But there are ways you do this buying and selling. So what you need, number one thing you need is a strategy. A strategy is your plan, a design plan to achieve a profitable return by buying or selling in the Forex market. Your strategy is what guides your buying and selling. Why are you buying a currency? It's all of those things are in your strategy. It is a plan, a system that you trade with that helps you make money from the market, because you can't just jump in as a novice then say you want to be buying or selling anything you don't know about. So your strategy is basically the knowledge aspect, the investment, the most work you do is in your strategy is what differentiates, in most cases, what differentiates a profitable trader from one who is just gambling. If you don't have a strategy in the Forex market, you are nothing but a gambler, just like you are placing bets on currencies. But strategy is how you determine a profitable pair or currency to trade. So the next thing you need is a broker. So what do we call a broker? A Forex broker. You need a Forex broker to open an account with a Forex broker. You cannot access the Forex market as an individual. So the broker is just like a company or an individual. Helps you buying and selling of currencies. So they help you with your orders. You as a trader, you find your currency that you want to buy or sell, or as an investor. So it's through your broker that you are able to access the market. Individually, we don't have the capacity or the requirements to be able to enter the Forex market itself. So it's through a broker. A broker is an online platform. They are registered, they are regulated by different countries. Example is FXTM, also known as Forex Time, Alpari, Hot Forex, Insta Forex, and etc. You might have been hearing of all these other brokers on adverts online, like Olymp Trade, Binomo, and many of them. They are also Forex brokers, but there are different types of brokers entirely. But the main Forex market in Nigeria, these are the leading brokers that you can trust your money with. So that's that for broker. Broker, and then that's where you fund your money to trade the market. And then the next one is what we call trading platform. So what is a trading platform? A trading platform is a software used for trading. It's just like a hub. Let's say we have a platform is just like a hub that collects your orders. Okay, you want to buy this, you do that on your platform. Your platform connects you to your broker and then to the forex market at large. The trading platform is the next requirement that you need. And then we have the most popular trading platform is called MetaTrader 4. And then we have MetaTrader 5, TradingView, and so on and so forth. So the trading platform is where you place your orders, you buy and sell on your trading platform. Once you have created an account with your broker, then your broker will give you a login detail that you will input on your trading platform. For example, your MetaTrader 4. So your trading platform provides you the data of the market data. They provide you with the market data and everything. You access the market, but the broker is who manage your money for you. They are the ones that manage your order, but the trading platform is where you execute your trades. Let's say you want to buy, you have to do that on a platform. The platform connects to your broker server and then to the Forex server at large. Then the last thing that you need, last but not the least, there's more actually, but these are the basic fundamental needs that what you need to start trading. Then is capital, and I put here real or demo. That is a real money or a demo money. You can only make money with a real money. But a demo, why I added demo here is because as a beginner, in most cases, when you are still learning, it is better for you to trade with a demo account. So that is provided by your broker. Your broker, when you create an account with your broker, they will give you, you have access to create a demo account, which is a demo money, virtual money that you can trade with for the mean. That's why Forex is a good business to venture into, even if you don't have the money yet and you are still developing yourself. You don't have to risk your money all the time you are trying to learn. So you can learn with a virtual money, and then once you see that you are good, then you can put in your real money. It's only when you have a real money in the market that's when you can make money. But your demo account is just like a practice, then you work on your strategy and everything as a beginner in most cases. So that's for that on what you need for trading. Then we go to how do you make money trading. So we have talked about Forex as buying and selling. So how do you make money as trading in the market? Here I talk of orders. Orders refers to how you enter and exit a trade. You can't make money if you don't place orders in the market. You can deposit money with your broker, but if you don't place either a buy or sell order, you are not making any money. So an order is important. You place order to make money in the market. And then we have different types of orders. These are just basic that you should understand. So when you get started with your broker and platform, to be easier for you as we move on. So we have what we call market orders, which are instant buying or selling of current market price. For example, this is EUR/USD, which means Euro versus US dollar, which is a currency pair. We are going to get into that very shortly. Is trading at 1.2140. That means this is the price of this currency in the market. And then you as a trader, you want to come in, either you want to buy or sell this particular currency pair. That is simply buying or selling it at instant price. When you use a market order, then your order is open immediately. That's for market order. Then another type of order is limit order. A limit order is placed either above or below a market price. For example, we talk of Euro USD again. It's currently trading at this particular price, 1.2050. But you want to go short if price reaches 1.2070. That means at this price is lower than this. Or let's assume this particular Euro USD is still going up, but you expect a particular point where price is going to drop, and then you cannot stay in the market till price get there. Maybe for one reason or the other, you don't know when price will get there. That's when you use a limit order. You place a limit order in a situation whereby you are not in the market and then price is going in that direction for you, then you expect price to turn at a particular direction. That's when you place a limit order. So we have two types of limit order. We have the sell limit, then the buy limit. When you use a sell limit, it simply means you want to sell when price gets to a higher price. So for instance, 1.2050 is lower than this, but you have a idea of selling this Euro USD when it gets to this, but the current price is at 1.2050. So it means when price goes up, when you are going to place your limit order at 1.2070. So it means when price moves up to this level, your order will be open. They are monitored by your broker. Like I said earlier, the broker is where you manage your orders. Your trade and everything is done on the broker. So you can place these orders, you can set these limit orders on your broker. Once price gets here, your broker is going to activate it, and then your sell trade will be live. The same thing goes if you want to buy it. You can also use a buy limit. Let's say your price is currently, let's assume now, let's interchange it. The price is currently at 1.2070, which is higher than this. But you expect that when price comes lower to this level, it is going to reverse and move up. Let me look for it too. It is going to reverse and move up. So let's say price is currently here, and then this is where you are targeting to buy it, the market. I'm just using this to illustrate. So you use a buy limit. You place a buy limit order here, so that when price comes down, it gets here, your trade will be activated, and then it moves back up. Then you'll be in profit. Sell when you expect price to go down. So those are the two important things in the market. You don't just place buy or sell at any point. You only buy when the price is very low, and then you expect that that particular price currency pair is going to go up. So when you buy it, it means price continues to increase. Then you start seeing profit on your return. Or maybe price is too high, or at a particular zone where you expect that this particular market is going to drop. So you sell at that high, then you'll be in profit when price starts to drop. So that's for that on market orders and limit orders. So this is it: buy limit, order placed below price, and price then goes up. So you can see the illustration goes up, then this one comes down. Then the third order type is top orders. In this case of limit is when, let's say for buy limit, is when you know that price is going down, then it is going to go up back. Then you place a limit at a lower price. While a sell limit is when you know that price is coming down, but it is going up at the moment. So when it gets to a point to drop. But a stop order is when you want to enter a market as it is going up. Let's say you expect that GBP USD, which is Great Britain pound versus US dollar, is currently trading at 1.5050 and is heading upward. You believe that price will continue in this direction if it hits 1.5060. So you have seen a level that if price should get here, it will continue going up. So this one is different from a limit order. In this scenario now, you see that price is going up, but if it gets to this particular level, it will continue to go up. It's not that it will come down again, depending on your analysis or your strategy. You are currently in the market at this point. You are not sure if you will be on the market when price gets to your target area. You don't know how long it will take. So that's why you use a stop order. So once price gets there, your trade will be activated by your trading platform. Your trade will be activated, and then if price continue as you predicted, then you will be in profit. The same thing for a sell stop. Remember, the only So two things that we do in the market is we are either buying or selling. We don't do anything else. It's either buy or sell. So all of this we are talking about here is the type of orders you can place depending on your trading system or the time of you are in the time you are in the market. So let's go to currency pairs. I said what we trade in the market is currencies. We trade money. But in the forex market, we call them currency pairs because currencies are quoted in pairs in the forex market. You can't just see Nigerian naira alone. You can't just say you want to buy Nigerian naira alone because we call it foreign exchange. It is an exchange market. Like I said, it's either you are buying one currency and selling another one, or you are selling one currency and buying another one. Let's say, for instance, you are traveling abroad, or in the scenario when you need your bureau de change, you are exchanging your dollar for naira. So it's always in pairs. You can never say you want to trade one currency alone. Is the forex market is an exchange market, so the currencies are quoted in pairs in the forex market. That's why we have been hearing GBP versus US dollar. So now the currency pairs examples are GBP USD, which is Great Britain pound versus US dollar, or USD JPY, US dollar versus Japanese yen. The reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. So this is how a currency pair will appear on your trading this thing. It will be a currency pair, one at the front, one at the back, and then there will always be a price, what we call a quote. There will always be a price that currency pair is trading at. So the first listed currency on the left side is what we call the base currency. And then the second one on this side is what we call the counter or quote currency. So what the base currency means is that for this particular, when we say a currency pair, let's say for this GBP USD, you see GBP USD is trading at 1.7500. What that means is that GBP, which is the base currency, is trading at US dollar 1.7 So it means for every GBP that you need 1.7500 US dollars to get one Great Britain pound. Since we say we are buying and selling, we are using one currency to buy or sell another one. So this quote currency is what determines the quote price here. Every currency on the base is the basis of the transaction that you make. So any currency that is on the right side is the base currency, and then anyone on the left side is the counter currency that you are using to buy or sell this base currency. We have the different major currency pairs, which are Euro US dollar, Eurozone US dollar, United States, USD JPY, GBP USD, Great Britain pound, and US dollar, USD CHF, which is US dollar versus Swiss franca, that is the Switzerland franca, US dollar versus Canadian dollar card, AUD Australian dollar versus US dollar, New Zealand dollar versus US dollar. So those are the major currency pairs. There are many more currency pairs that you can trade in the market. So these are the things that you trade when you are in the forex market. Euro, USD, and so they have their quote price. And then we have another thing that we call pips. Pips is the unit of measurement to express the change in the value between two currencies is called the pip. So the pips is how you measure the price movement in the market. So we talk of the price of Euro US dollar at 1.2250 to 1.251. That is one pip movement. This difference, this one value at the end here is the pip value. We call it pip value. So that movement from 2250 to 2251 is one pip movement. So if it moves 10, 20, it can move. So the measurement that we use to count your money, the money you can make or profit or loss in the market is what we call the pips. So you need to understand the pips, how to measure the currency pairs too. So this is an illustration of the pips. So this is like a six figure price, a six figure quote, and then the last digit here is a micro 0.0 pips, and then this 8 pips, 30 pips, 50 pips, 1000 pips, then 10,000 pips. And then the next one is bid or ask spread. All forex quotes include two-way price, the bid and the ask. The bid is always lower than the ask price. The bid is the price in which the broker is willing to buy the base currency in the exchange for quote currency. So what is the bid? This bid and ask. You always see that whenever you want to place a trade in the market, because you can only access the market through a broker. And how does your broker make their own money? They make their own money by charging a little, very little commission on every trade you place. So they will give you a price, a bid price, and then they will give you a ask price. A bid price is which when you want to sell, you use the bid price. The bid price is higher than the ask price. But when you want to buy, they give you a ask price, which is lower. So the bid and the ask, then the difference between the bid and the ask is what we call the spread. The spread is how they make their own money. So the value and all of these movements is in pips. These pips that we talk about. So because they are still quotes, their prices. So all this value, the difference between this bid and ask is spread, and this spread is the unit of the spread is always in pips. So the amount of pips that your broker is charging you per trade or for a particular currency, converting that to money based on the trade you take is how they make their own money. For they don't charge you if you don't take trades. They only charge a little commission depending on, and they take out the spread immediately you place your trade. So that's for bid and ask price. So this is an illustration with this again, a base currency, counter currency. This is the bid price. It is lower than the ask price. This is the bid price is the price that you sell, and then the ask price is the price that you buy. So then the difference between the bid and the ask is in pips, which is your spread, which is 2 pips. For this particular currency quote now, the spread is just 2 pips because we say the movement of market is in pips. So if you are going to calculate your profit or loss in the market, everything is depending on pips. Let's say you buy at a lower price. Let's say you buy at 10.50, and then you want to close your trade at 10.80. That is, you have gained 30 pips of price movement. You convert that, multiplying it with your lot size, which we are going to discuss next. You'll be able to determine how much you have made in the market. So that's how you calculate your money. And then the next one is lot size. So we say we are buying and selling. Now we are buying currencies and all. But what amount of this currency can we buy or sell? There is also a volume of currency pairs that you can buy, which is determined by your lot size. The number of currency units you will buy or sell. The standard size for one lot unit is 100,000 units. So just know that the lot size is how you calculate your money. So let's say for the last this thing we talked about, we say 30, you gain 30 pips. The amount of money you make if you place a standard lot size will be higher than the amount of money when you place a 0.1 lot size, because this lot size is just like a multiplying factor that determines the amount of return that you make per trade. So let's assume for one standard lot size, you traded 100,000 units of currency. It means for every pip, call something pip value. Let's assume the pip value for one lot size is $100. Let's say you open a trade now. As price continues to move in pips, for every one pip movement, that is when you place a standard lot, one lot size trade, you are gaining $100 for every pip movement. But when you use a micro lot size, you might be making $10 per trade, per pip movement. So that's the difference between lot size. So, and this lot size is dependent on your account size. That's the essence of lot size. Someone who is trading with a one standard lot size would normally must have up to this $100,000, or depending on the currency you are trying to trade. So it must have up to $100,000 because that's the standard unit. That's the units of a standard lot size in a standard lot size. But if your account size is now lesser, that means you'll be restricted to trade only lower lot size until you have grown your account to this level to trade a standard lot size. But now there's a trick to this. Let's get to that also. And this is what we call leverage. So leverage, yeah, because we say before you can trade a standard lot size, you must have up to 100,000 units of the currency you want to trade. Not every trader have this money to start with. But in those days, before trading started online, in those days you must have up to all this balance thing. But now we now have what we call leverage. And leverage is what your broker provides you. It's as if when you have a small amount of money, now you can trade larger value of money. Let's say you have a 1,000 unit of your currency. With the help of a leverage, you'll be able to trade up to 100,000 units. If you have 100,000 units, with the help of a leverage, you can be able to trade up to 100,000 units. So that's what leverage means. And this is provided by your Forex broker. It's just like we call it a borrowed capital to increase the potential returns you can make. That's another benefit of Forex trading. You don't have to have the largest sum of money to be able to make big money. With the help of leverage, you can be able to make good returns from the market. So that's what leverage is all about. Your broker simply lends you some money. They increase the capacity of your money. Let's say you put in $100. They amplify the effect of that $100 by giving you leverage. They give you margin to trade with. So with that $100, you can be able to trade up to the value of $100,000. It means you can place trade that can be worth 100,000 units of currency. And then each return you make on that trade will be your profit. They won't take it from you. It will be your profit. But the side effect of leverage is that the same way you can make big money with it is also the same way you can lose big money with it if you don't know how to trade or bad trading strategy or anything. So that's why you have to be careful when it comes to leveraging. And as we go on, I will be providing more guide about leveraging. So because we say developing a strategy is simply how you place your trade. So before you can trade any currency, you have to analyze it. It's just like forecasting a pair. You have to know, okay, so how do you know? This, what we call trading analysis, simply means how do you know if market is going to go up? How do you know if it's going to go down? You know, we buy when we expect it to go up, we sell when we expect it to go down. But how do we know when price will go up? How do we know when it's going down? That's where you have to work with a trading analysis. And then we have two basic types of analysis you can take when approaching the Forex market. The number one, we call it the fundamental analysis. And then the second one we call the technical analysis. So the fundamental analysis is a way of looking through the economic, social, and political forces that affect supply and demand. In other words, You look at whose economy is doing well and whose is not doing well. We call it fundamental. It simply means news. We call it news trading at sometimes. So it's like we have the exchange rate for Nigeria as 350 or so now. 350. Let's assume it's 350. Why is this exchange at 350? It simply means over time it was not like this before. We have time when Nigerian economy was good, was performing well. The exchange rate was lower then. But as the economy of one begin to gain more strength over another, the price will increase. So it means we are now needing more naira for us to get $1. That's simply fundamental trading. When you know the economy of a country is doing bad, you simply sell the currency of that country and you buy the currency of an opposite country that is doing well. For example, the US and Nigeria. Let's say you have US dollar, Nigerian naira as a now that we know that US is doing better in terms of economy, or maybe there's any news, any data that comes out and then that reveals that US is doing better in terms of maybe power or anything. That kind of news is a potential trading opportunity. Fundamental traders will simply sell Nigerian naira against the US dollar because they believe US dollar is gaining strength. So automatically, for that particular pair, USD, NGN, Nigerian naira will be dropping, but US dollar will be going up. So that's what fundamental analysis simply means. You compare economic data or political forces, anything that can affect the economy of a country. You collect those data, then use it as a basis of your trading. And then the next one is what we call the technical analysis. The technical analysis is the study of price movement. We are talking of trading analysis here. The two types of trading analysis you can use. That's the analysis simply means forecasting the market in order for you to know when to buy or sell in the market. So the second type of analysis is what we call the technical analysis. Technical analysis is the study of price movement. We call it technical. It means you are dealing with raw charts. Technical analysis is study of price movement. In one word, technical analysis goes to charts. So you are dealing with the chart alone here. You are not dealing with economic data or anything. Everything you are taking your trade based on is what you see on the chart. Yeah, that's what technical analysis is all about. So it means you can look at historical price movements and based on the price action and can determine is at some level where the price will go. By looking at charts, you can identify trends and patterns which can help you find good trading opportunities. So that's what technical analysis is. You are taking your trade based on what you see on the Forex chart. So that's that on the two types of trading analysis, which helps you find trading opportunities. So the next one we talk of is Forex charts and time frames. I said earlier that the Forex, you need a broker, you need a platform. The platform is what displays the charts to you. So what is about this graphical representation of the change in price per time frame. So we all know what the chart is, but now we are talking of the foreign exchange charts. The chart is a graphical representation of change in price per time frame. It depicts the historical behavior across varying time frames of the relative price movement between two currency pairs. So price on the right side and then time on the horizontal axis. So all of this brings out the data for you to analyze the market. And then we have what we call the time frame. It's the time at which a forex chart can be viewed, analyzed. Each bar of candlestick shows the volume of price movement within the specific time frame choosing. So examples of time frames are 1 minute, 15 minutes, 30 minutes, 1 hour, 4 hour, daily, and monthly time frame. So example types of charts. They have three types of charts. First one is the line chart, bar chart, and candlestick chart. But we just go straight to the most important one. The candlestick chart shows information about bar as same as bar chart, but is prettier graphic format. However, in candlestick charting, the large blocks in the middle indicates the range between the opening and the closing price. So let's just go straight to it. This is a candlestick chart. The chart is what helps you to read the market data, that helps you to be able to analyze the market and be able to predict price movement for you to take trades and be able to make money, profit. So you must understand the charts. You must be able to study the chart and make your analysis. So this is a candlestick chart. This is an example of a candlestick. This is how you'll be seeing the candles on your chart. Let me pull up my chart here. Like this that you can see here. This is a candlestick, different candlestick showing price data. The block area is what we call the body, and we have two types of candlestick, the green one and the red one. The green one indicates a bullish movement. That is, when price goes up, a green candlestick will be formed. When price goes down, a red candlestick will be formed. So in the case of a green one, let's study how this candlestick forms. So the low of this bar is the open price. The high of this bar is the close price. The tip of the shadow, this thin line, we call it shadows or wick. Like a candle, a candle will have a wick. So you can call it a wick or a shadow. The tip at the top tip is what we call the eye. That means price got to this point. Because we are dealing with time frames here. We talk of time frames. So for this, depending on the time frame that you are viewing your chart from, it means for that time frame, price got to this point high, and then price also got to this point low. But when price closed, this is the body that is formed here. So, and then the same thing for a bearish candle, which indicates a downward movement. When price is going down, a red candle showing bearish movement will be formed. In a bearish candle, which is red, the open price is above. That means price opens here and comes down to close here. But before price closed, price got to this high. Before price closed, price got to this low. But when everything closed down, it closed to this point. So let me just use my annotate to indicate what that means. For example, this kind of market, price opens here, right? Let's illustrate with the line and closes here. So when price opens here, it came down this way, get to this low, then it went back up this way, it got to this high, then came down this way to close here. So this is our open, this is our close. But before this candlestick, this particular time frame closed, price got to these 2 points, which form the low and the high. The same thing when it is a red candle, that means price goes down in a red candle. Price opens at the top and then closes below. For this kind of illustration, I will say when price opens here, price went up initially to form this high, then came down to this low to form this low. But before this particular candle close was complete, the time frame was complete, price still came back up and then closed at this point. So this is the anatomy of a candlestick. This is how the candlestick. This green one represents the up movement when price is going up, but the red one represents a downward movement when price is going down. That's that for the candlestick. So why is the candlestick the most important? They are easy to interpret. It is a good place for beginner to start to figure out the market. So this is an example of a candlestick chart. So how do you analyze? Now we talk about the two types of analysis in the market, which is fundamental analysis and the technical analysis. How do you analyze in the market? Let's talk about, there are two methods of technical analysis, because in this training we are going to be dealing with technical analysis alone. In the more advanced classes, you will learn more about fundamentals, how to trade with the fundamental analysis. The two types of technical analysis: number one, we use technical indicators, because everything we are doing is on the chart. Our basis of taking trade, we do it on the chart. Why do we buy? Why do we sell? Everything is what we see from the chart. So what technical indicators means simply is that they are like softwares or programs mathematically that calculate price, volume, open interest, currency pair used by traders to follow technical analysis. So all these things, they are like softwares. They help you to look for trade opportunities. Based on these different indicators, this is an example of a technical indicator chart. All these things here, they are indicators. Based on all of these things, as a technical indicator trader, you look for confluences. You study some parameters of these indicators. These things they are like softwares. They are mathematically calculated. They calculate price data to give you something. So you use that to take trades for these indicators. Then the second technical analysis system is the price action analysis. The price action analysis, everything you are doing is with raw market data. You are not using any indicator. This is an example of a price action chart. Yeah. Everything you are doing is what you see on the price. You are not using an indicator to help you look for any confluence. So it is your ability to study charts and be able to know the sentiment, psychology behind formation of the chart to take your own trade. That's that for price action analysis. So how do you analyze trade with price action? How do you analyze and trade with price action? In order to be a good price action trader, you must understand and be able to read and interpret a price action chart. What do we call a price action chart? Is an empty chart where you don't have any indicator. The different parameters you must know as a price action trader includes market structure. We have two types of market structure, which is a trending market and a ranging market. Support and resistance, trend lines, candlestick patterns. We talk about candlestick initially. So for this beginners class, we'll be learning these four parameters. There are many more price action strategies that we use in the market. So the basic price action analysis, market structure. Because we say the forex doesn't always move in a straight line. This is because price is going to go up. It does not just go up, zoom. It will go, come down. It's just like when you are driving a car. When you reach a pothole, you decelerate. When you are out, you accelerate again. So it's not always a straight line movement. Let's say someone buy the market here, it will not just jump up to this next point. It takes time. It will move up, move down, move up, move down. So all these moves, these zigzag movements, they are creating structures. They are creating areas, zones in the market that helps the price action trader to predict price movement. So that's for price action, for market structure. So we now talk of types of market structure. We have a bullish market structure, bearish market structure, and the enraging. The bullish and bearish structure are called trending market structure, And the ranging market structure can also be called consolidating market structure. What does the bull mean? When price is going up, we simply mean bullish in the forex market. When you are seeing the upward movement of market of the price, we call it bullish. When it is going down, we call it bearish. When it is in a range, let's say like a box, it is not breaking up or down. It is just like moving in one sideways. We call it ranging market. So that's what we call uptrending, uptrend, downtrend, bearish, bullish. Let me show you that on the chart. Look at this. You can see that price is going up here. So we can say this is a bullish market structure. Considering this up zigzag movement as a bullish market structure. But when it is now coming down, and this at this particular point now, price is like coming down, we can call this a bearish market structure. It is coming down, creating lows. That's a bearish market structure. It helps you to know when to buy or sell. Understanding of market structure will help you know where to buy or sell, because the trend is your friend. This is what we call an uptrend. And then this small one that is forming now is what we call a downtrend. This is an uptrend when price is going up in zigzag manner up. This is a small downtrend. This is up and uptrend. This is small downtrend. That is what we call market structure. This is it here. Made some illustration here. When price is for an uptrend, when price is going up, it starts with an impulse, correction, impulse, correction, impulse, correction. This point is called the high. This is a higher low. This is a low point. This is a higher high. For a bullish market structure, the highs will get broken to form another higher high. We call the next high an higher high. Another higher low is created, and then when this one gets broken again, it forms a high, another higher high. That's for a bullish market structure. All of what we are still trying to talk about here is how you can analyze market and take trades on your own. This is all of these things there, they are necessary for you to understand. So why in the bearish market we call it a downtrend, when the market is coming down in a trending manner. You can see it forming in that zigzag. How markets move. Market does not just move because market is coming from here to here. It will not just move in one straight line zoom. They occur in zigzag manner. So understanding of those structures is what will help you to take trades on your own. And then the next one is the consolidating market. When price is neither clear in a clear bullish or bearish movement, not creating higher highs or higher lows in the case of trend. So this one now, price is just going zigzag in a sideways manner. You know, when it is an uptrend, it will continue going this way. If it is a downtrend, it will continue going this way. But in this case, it is just like equal movement, almost like equal movement. So this is what we call a ranging market. That's that for market structure. Now, trend formation and reversal. How do trends form and what do we call reversals? A trend is formed when we have similar market structure overlapping each other. A trend reversal occurs when a new market structure violates the previous one in the opposite direction. That's a reversal. So let me just go straight. This ebook will be provided for study later on. So this is a bullish market structure. what we call bullish is when price is going up, and then when price is coming down, we call it bearish. So this way, market is going up. This is a bullish market structure, a trend forming and breaking previous high and lows to create higher highs and higher lows. Likewise, for a bearish market structure, when price is going down, is forming and creating lower highs and lower lows. It is breaking the previous lows to form another low, and then there will be a correction to form a lower high. So in the case of reversals, how the reversal occur? When a particular trend gets broken, we call something an uptrend when it continues creating higher highs and higher lows. But when it now starts to change, let's say after a higher high, it fails to create another higher high at the top, then it forms a lower low. It is a downtrending market. It is a signal for reversal. Likewise, when it is going down initially, then it wants to turn back up, it stops forming lower lows. Then it is a signal for bullish reversal. Let me show you that on the chart. This is an example of this, what we are talking about here. Look at this now. This is a low, this is a high, then a pullback to form a higher low, then a continuation to form another higher high, then a pullback to form a higher low. So if we connect this with our trend line, we can say that we are in an uptrend. This is an uptrend. But when a reversal is going to start, as soon as the market fails to create higher highs, if this is if it will continue being in an uptrend, then this high must be broken. But here now we are unable to get to this high. So the market starts forming lower highs, which is the characteristics of a downtrend. So at this point, you can say that a reversal has started. So at this point, you don't buy again. You don't buy the market again. You start to sell when the trend has changed. A bullish trend forms, you buy when it is going up. But now that it is turning down, you look for selling opportunities. For selling opportunities in the market. So that's about trends and reversals. That's it. When a trend line is broken, you place your trade at the retest of the broken trend line. So this is a trend line that was broken, but when price come back to retest it, you can sell it right here. Just for instance, look at this trend line. Initially, we have this trend line from market is bouncing off it, going up. But once it gets broken, you can see exactly the perfect scenario that came up here. We saw the retest on that trend line, and then market starts to drop. So if you want to look for a trading opportunity, a reversal opportunity, you sell when price is retesting a structure. So if you sold this here now, you'll be in profit as a trader. So you look for reversals or a trending market when price is trending. Okay, support and resistance. These are areas of the market where a trend reversal is expected to occur as a result of initial price rejection on such levels. So a support is the price where a downtrend is expected to stall, that is to stop and reverse to an uptrend. It acts as a floor, area where price bounces. A resistance is the price level where an uptrend is expected to stall and reverse to a downtrend. This area acts like a upper ceiling where price reaches and falls back. So look at it. Support and resistance. When price gets to a resistance, it will fall. It drops. That's what a resistance is. Resistance is like an upper ceiling. When price gets to support, it goes up. Then the support is like a floor. When you bounce a ball, it will go up. So that's what support is about. So you buy the market at support, you sell at resistance. So let's look at this same chart that that is open down here. This is a support area. This is a resistance. So once price gets to a point and it gets rejected, the market creates a structure here, resistance. So price drops down, comes back there and drops again. That's a resistance for you. And then creates a support here. Support is areas where market goes up. So now the market is going up. And one thing about support and resistance is that if one structure is broken, it automatically becomes the opposite. Initially, this is a resistance, but once it gets broken, it becomes a support. The support is where price gets to and goes up, but the resistance is where price gets to and comes down. Now that the market has broken this resistance, previous resistance, market goes up, pulls back to this resistance area again, and that resistance becomes a support for market to go up. So you see, another resistance created here. The same support played out again. Market goes up, market tries again before it fails to continue. When the support or resistance is broken, a retest on such area is a potential zone to place your order. So let's go to candlestick analysis. Candlestick formation. Candlesticks are formed using the open, high, and low. We have talked about the candlestick before, but now let's go in depth. How to look for trading opportunities with your candlestick. How does the market react? Candlesticks are great tools to understand market conditions by studying the different kinds of formation. So this is primarily what the candlesticks look like. It consists of, depending on price movement, if it's a bullish, if market is going up, it forms a green candle. If the market is coming down, it forms a red candle. For a bullish candlestick, the open is below the close. For a bearish candlestick, the open is above the close. So that's it. So the different kind of candlestick patterns. Long versus short body size. We know what we call the body size. So now when we have a long body and a short body, what that simply means is, for a long body indicates a stronger and more dominant buying or selling pressure for the particular session before the close of the bullish or bearish candlestick respectively. So let's look at this candlestick. These are two candlesticks. This is for a bullish movement. This is for a bullish movement. This is for a bearish movement. We know bullish movement is when price goes up. Bearish movement is when price goes down. What a candlestick shows is what the dominant price movement is within that particular time frame. But now the different sizes of the body gives us important information to know about the market. When a candlestick has a longer body like this, it shows that there is more pressure, there is more buying pressure in the market. More buyers are in the market at that time. So they drive price up to create a long candle within that short period of time. But when it is a short candle, it shows that the pressure is low. So in this kind of situation, you be careful to know what the market is doing. when you see this, you know that the buyers are in control. This is also buyers work, but the pressure is not as much as when it is long. The same thing for a bearish candle. When it is coming down, it's in a long, forming the long candle, it shows that the small sellers are in power at that particular time. So long wicks candlestick. Long wicks indicates the area where price can be pushed quickly in a short amount of time and potential reversals in the direction of price. We can deduce from a long wick that price made a big move after the open, but it was pushed back before the candles closed. So let's look at this. This is a bullish candlestick. This is a bearish candlestick. But what makes this different now is that look at the wick. Look at this long wicks or shadows that we are seeing. It's forming a small body with a long wick. This shows that within this period, within this particular time period, the market came down here and quickly pushed back up. So it shows that initially the sellers started driving the market down, but when the buyers came in, they took price up immediately and very fast, rapidly. So they were able to close the market above to form a bullish candle. So this kind of week, when you see something like this at a structural area in the market, it is a signal. This kind of week can give you a signal to buy the market. It shows that buyers are now in control. And when it is a red candle, it shows that sellers are now in control. That the buyers try to push price up, but very quickly the sellers came in and pushed it back. That's why we have this long. So let me use an update to illustrate what. So let's say the market opens here and closes here, which is the properties of a bullish candle. The market opens below and closes above. So when the market opens here, it came down. The sellers were still in control at this point. They were pushing price down. Or maybe this is a structural area. Let's assume this is support whereby then the buyers came in. They pushed back price back up very quickly to create this candlestick. So all of this area forms the wick. Then this is where the candlestick usually forms. So this is a good signal when you find it in the right position in the market. So candlestick pattern. These candlesticks are the basic visual units of price action. Recognizing their implications within the greater narrative of price crucial to the price action trader ability to enter and exit position at the most advantageous time. So now we are talking of candlestick pattern. So combination of one or two candlesticks give us pattern in the market. And they're always telling us a story. They're always giving us a clue of what is going on in the market. Let me look for an example here. Good. What did I say about a bearish pin-bar? Look at this. Look at this candlestick. Similar to what this looks. So it means that at this point, people were trying to buy the market. They drove price up to this level. But when the sellers came in, they drove it down. And you see the aftermath of the same thing. You see how price moved and dropped to this point. So this is a signal that sellers are in the market. You can sell it at the close of this candle and then you'll be in profit as price continues to go down. Look at the same thing here for a bullish pattern. You see the long lower shadow. As that long lower shadow forms, it shows that buyers took price because it was able to close as a green candle. It means it is buyers pressure. So once that candle closed, look at what it created, creating this long candlestick again, which is also showing the strength of buyers in the market at that time. So the engulfing bar candlestick. This pattern consists of two or more candlesticks, where the later candlestick body is longer. So look at this bearish engulfing candlestick. What do we call bearish? Is simply downward price movement. But here now, this pattern tells us that sellers are now in control of the market. When spotted at the end of an uptrend, it shows that buyers are losing control and may signal a bearish reversal. Before a long bearish candle form, you see this short bullish candle, and then this thing came up. What does engulfing mean? It means the size of this new candle completely covers almost twice or more than twice of this initial candle. This one is smaller compared to this. So let me look for that and see how it actually works in the market. I'm trying to look for a good setup. Look at this illustration here. This new candlestick completely engulf this candlestick here. This is a signal of buying pressure. That's for a bullish candlestick. When the new candlestick completely engulfs the old candlestick, a doji candlestick pattern. This candlestick tells us that the market opens and closes at the same price, which means there is equality and indecision between buyers and sellers. There is no one in control of the market. This signal means that the market didn't decide which direction it will take. When this pattern occurs in an uptrend or a downtrend, it indicates the market is likely to reverse. So this is a doji candlestick. This one is neither green or red. It means that the opening price is the same thing as the closing price. Then it formed something like this. Let me use this to illustrate. This is the opening price, the same closing price. Let's say market opens here, goes up, comes down, still came back to close at the same level. That's why we have this wick up and wick that formed there. So the dragonfly doji. Let's look for a doji candlestick on the chart. That's a doji candlestick. See how price continues to move up after that. Shows price indecision in the market. Dragonfly doji. This candlestick pattern is characterized by the long lower tail. Shows the resistance of buyers and their attempt to push the market up. The open high and close are almost on the same price. This is the opening price, this is the closing price, almost all the same price. But this one now formed a long tail. It shows that buyers took over the market and then pushed price back up to this extent. So when you find a dragonfly doji at a support area, it's a good opportunity to buy because the buyers form this doji. It is a form of resistance for price there. The gravestone doji. This is the bearish version of the dragonfly doji. It's just like when you find this at the base, at the support area, and you find it at the resistance. This is a good opportunity to sell as it shows resistance of sellers. Sellers through price back down. Candlestick patterns are great signals for trend reversals when spotted at key market structure, trend line, support, and resistance zone. So take note of those market structure, trend line, support, and resistance zone. So bullish reversal candlestick for a market that will go up. When you find something like this, this is also a pin bar, long big candlestick. It is a sign that the market will go up. When you find something like this at the support area, it's a sign that the market will go up. Or when you find this at the resistance area, it's a sign that the market will drop down. Finding trade opportunities with the basic price action analysis. So when do you buy, when do you sell? Buy at the support, buy at the third touch on a bullish trend line, at the retest of a broken resistance, at the retest of a broken bearish trend line. You sell at the resistance, you sell at the third touch on a bearish trend line. What is the bearish trend line? Trend line coming down. At the retest of a broken support, at the retest of a broken bullish trend line. So that's basically when you buy or sell. So look at this now. This is a chart example. You sell at resistance, you sell an opportunity at the resistance, and then you buy at the support. You see price jumping up after hitting the support area. So these are good places to buy and make money, make profit as a trader. These are not trending markets. Support, resistance, diagonal way. So you can keep buying at this support as long as the trend integrity is still intact. That is, the trend has not been broken. It keeps forming higher highs, higher highs, higher highs, and higher lows. But once you see that it is unable to form a higher high, that is a signal that a reversal is likely to occur. The same thing for a downtrend. When it keeps forming lower highs, lower heights, then it is still the integrity of the downtrend is still intact. But when it fails to continue forming lower structures, then that's a good signal that the trend reversal is coming. Then the sellers surrender and then the buyer will take over. Uptrending markets, same chart. So yes, this is a ranging market. That is when market the price is neither in trending manner or a bearish or bullish manner. You can see a range is like having two structures. You have a ceiling at the top and then a support base. The market is unable to break out of that structure. That's what we call a range. So you can buy at support, sell as resistance, buy at support, sell at resistance, buy at support until you find out that okay, market has changed the structure. You see, ranging market, you sell your this is resistance. The resistance has been created here, and then the market comes down, then came back up there again. This is a good signal to sell. You see the pin bar structure, the long wick rejection candlestick signals that sellers are in power. Then they drove the market down. The same thing when it's a breakout happens. Breakout is when market breaks out of a structure. This is a ranging structure, but now price is breaking out of it. When price breaks out of it, test, then it is a sign that it continues going up. So basically, these are the basic knowledge that you need to start with in the market. So what you need now is to create a broker account. You register with a broker, choose a broker. I can drop a link of Nigerian brokers that you can register with. Then based on this particular class, you can start looking for trading opportunities for yourself. This is a support, this is a resistance. A broken resistance becomes a support. You see, a resistance is where price gets to and drops. A support is where price gets to. So let me pick another chart to show you. This USD card. Okay, this is an example of a trending market. That is, it keeps creating higher lows. All of this pullback, this is what we call pullback. This is from the low, this is the high. Then it created the pullback, create this higher low, continues up, create another higher low before the trend gets broken. You can pull out a trend line. The trend line is a drawing. So what you will do after this class is you will install your trading platform, which is MetaTrader 4. You can search that on your Play Store or install it on your computer. For you to create a broker account, you must have a broker account, which I have stated here before as the requirement for you to start trading. Your platform is example of your platform is this MetaTrader 4. And then in placing orders, these are instant market execution. You sell or you buy. Buying or selling, that's what the market does. And then we talk about bid and ask price. Sell limit, buy limit, currency, yes, the PIPs, bid and ask spread, which is how your broker make their own money. The difference between the bid and the ask is what we call the spread. The bid price is the lesser price where your broker sell for you. The ask price is the higher price where your broker buy for you. So the little increments, those prices is how they make their own money, and the PIP are always very small for them. So your lot size is how much volume or units of currencies you are buying or selling. Which is what converts the number of movements you are able to convert. Then leverage is the borrowed funds that you get from your broker for you to be able to trade large sum of money. Types of trading analysis, the fundamental analysis and then the technical analysis. We talk of fundamental as being the study of economic data, social political forces that affect the economy of different countries like that, depending on the currency pair. So you use fundamental trade analysis to trade based on where news or the economics of those countries. And the technical analysis is where you study your chart and be able to make good trading decisions based on what you see on the chart. Like how we have been able to do some examples with all these charts here. In the Forex chart, time frame, types of charts, line bar chart, line chart, talk of the open, close, high and low price, the candlestick, which is the most important and widely used chart system. So I'm going to drop the ebook so you can still do further, can get started and be able to make profitable trades based on this. In the intermediate and advanced classes, we are going to further how to develop your trading strategy, a more advanced market structure trading system, price action, which are more advanced, the use of Fibonacci, supply and demand strategy, price harmonics pattern, how you can use price pattern, make trading predictions. But first of all, you must understand these basics so that we can move on to the next classes. Most of the charts I post on my group because I use harmonics a lot. A lot of people don't understand it, but we need to start from the simplest parts to the more advanced parts. Everybody will be able to roll along with me and be able to take trades that I post on the group. So these are the basics that you need to understand before we can advance in the learning of forex trading and how you can be making more money, support and resistance, broken sub broken resistance becomes support, candlestick analysis, how the candlestick forms, what are the anatomy of the candlestick, the open high, close and low, the long, how does the length of the candlestick affect style? What is the story behind the length of the candlestick? You now know that, be able to understand the sentiment behind all of this candlestick formation. You know, when you see a long candlestick like this, it means buyers have more pressure on the market. They're able to drive price to move fast within a short time. That's when you see long candlestick. And then when you see short candlestick, it means either buyers or sellers. When you see short candlestick, they are trying to push market, but they are unable to. So the longer candlestick have more power, have the strength. So you know the green candlestick starts for buying pressure, and then the red one stands for selling activity. Candlestick pattern engulfing back candlestick, bullish engulfing back candlestick, the doji, which is when price are closed at the same price, and the reversal patterns. So finding trade opportunities. When do you buy? When do you sell? You buy at a support, you buy at a third touch on a bullish trend line. Hi everyone. So this is the second part of the video. Fortunately, while I was recording on the webinar session, I was only sharing the PDF screen. So I didn't realize the other screens was not sharing. So I have to create this second part to further explain on chart and the analysis aspects of beginners class. So let's get into this. So this is a platform and it's called MetaTrader 4. This is what your broker will give you to trade with. So you create your account with your broker, FX team, and you download your platform, MetaTrader 4. So this is it on your chart. This section is where we call the order section. So you instant execution, buy or sell, buy or sell. Then if you want to place pending orders, you can do that by right clicking orders, sell limit, buy stop. So these are currency pairs on the right side here, currency pairs. And then in Forex, you also trade other commodities such as natural gas, crude oil, Brent oil, and indices. Then we talk about charts. So this is a candlestick chart on your platform. Then we talk about time frame as well. What price has done within 1 hour, 2 hours, 3 hours, 4 hours. So right now we are on a 4-hour time frame on this chart. You can go as big as the monthly time frame to see what price has done. It's just about seeing the bigger picture in the market. So this is a monthly time frame. It means each candlestick on this chart is formed within in a month. So each candlestick here represents price movement in 1 month. And we can go to the weekly, shows price movement in 1 week. Each of these candlestick contains weekly time frame. Daily, you can go down to the daily and see what price is doing in the daily candle, in the daily time frame. So down to the hourly time frame, 4 hour, 1 hour, 30 minutes, 15 minutes, and you can go as lower as 1 minute. See what is happening per minute in the market.
So because we have different trading system, you are either a swing trader or a intraday trader or a scalper. If you are a swing trader, you'll be dealing majorly with the monthly, weekly, and daily time frame, and most times 4 hours too. But if you're a day trader, you're dealing with daily, 4 hour, 1 hour, and then the minute time frame. But if you are a scalper, scalpers deal with the minute time frame most of the time. Depending on your trading style, you can determine what time frame you want to be trading on. So that's for the time frame. Now we go into the analysis. So also we talk about lot size. This is where you input your lot size when you want to trade. Standard lot, mini, and micro lot size. So this 0.03 is micro. Can go as high as 0.09 or as low as 0.01. So you are trading with micro lot size. You can go to the mini lot, which is the first decimal place, and then you can go as the standard lot size, which can be 1, 2, 3 to up to 100, depending on your capital or your leverage. And then pips. So how do you measure your pips on your chart? This is a tool that you can use to measure your pips. Let's say from this point to this point, you want to know the amount of price movement, the number of pips. We say that pips is the unit of measurement of price movement. So from this point to this point. So let's go to the basic price action trading. We talk about market structure, support and resistance, trend line. What is market structure? It's about knowing areas of structure, areas where price respect in the market. So look at this market now. You can see price movement in this manner. And then we can have a support line. And then what happens within this support line? You see how price bounces up, moves up to this resistance, drops, creates a resistance here. Because this is a new resistance. Okay. So price creates a resistance here, came back down, and then respected that same resistance again, thereby creating a new support here. So from this resistance, price dropped down to the previous support, breaking this particular support area again. But when it dropped, it moved back up. This is still a zone. This area is more like a breakout retest. Then it still dropped again, creating still respecting this support area. This 1, 2, 3 touch, and then it moved up. You see that this same support here is still valid at this point. Price still came back to respect this support line area here. Then price went up, breaking this area. This sometimes in more advanced classes we'll talk about fake outs and breakouts better. This is more like a fake out because price still came back into the zone to respect this resistance. That is basically support and resistance and market structure. Market, trending market. What do we consider a trending market? When price keeps creating series of higher highs or higher lows, or lower highs or lower lows in the market. It is basically price moving in a diagonal manner. So we can see this kind of market movement. You see this came back down, came back, went back up. You see what price is doing here is that it is unable to break previous lows. It is rather creating higher lows. This is the low. It created this high, created this higher low, went up, created another higher low here, went up, created another higher low. So we don't know when price is going to, where exactly it's going to create new higher low here to continue up, or it might just break it and change the trend. So in this manner, we can say this is an uptrend. So what you do is bring out your trend line from there, and then connect the lows together. It does not have to be perfectly touching it, but just draw it. So that will help you know until this trend line has been broken. That's when you can say, okay, the trend is changing. But here we can have this number of touch. 1, 2. Okay. This is also an example of an uptrending market. You can see this, the way price keeps creating highs, higher highs, higher lows. You can connect this way. So you see higher highs, higher lows. Then a breakout. That's when you are experiencing trend reversal. Breakout, retest, and then continuation to the downside. You can have this, and then you can still have this. It's more like a mini uptrend already forming also in this uptrending market. You see, created a high, a higher low, higher high, higher low, higher high, and possibly another higher low here for it to continue moving up. That's trading the trend strategy is just after the first two touch. We call the first two touch tentative touch, tentative trend. So on the third touch, that's when we call it confirmation. Once you can get the third touch on the trend line, then you can confirm that this is an uptrend, this is a downtrend. So to trade it, you enter at the third touch, then every other touch following it, you can trade it until you notice a reversal area or an area of structure. Somewhere like this can change a trend. Something area like this can cause a trend reversal here. The price will start falling again. So until you notice areas, structural areas like this, you can still continue trading the trend strategy, trend line strategy. Okay, this is an example of downtrend. Here's this one. So this is it. You see how the trend started for created a lower high. Started from this high, created a lower high, created a lower low here. But before then, we saw the third confirmation touch. So this is where if you are going to trade a trend strategy, once you've seen the first two touch on the trend line, you wait for the third touch. You enter your position at the third touch. And the third touch usually creates the impulsive, the highest, the more impulse in such trend. So you can see how it dropped over here. So we can be expecting one or two more touch on this trend line, and then price continues to drop. Let's look for a consolidating or ranging market. What do we say a ranging market is? When you are not seeing higher highs or higher lows. But in this particular market, price eventually broke out of it. So this is how it started. Price came down, went up, came down, went to create this support, resistance, came back to that support, went up, came back to the support. So it was moving sideways within this range before this breakout. So for someone who wants to trade this breakout strategy, you wait for price to reach the structural area. This is a structural area, a resistance here. So broke it to this high, came back to retest on this resistance, dropped, came back to the support. Another opportunity to buy, another opportunity to sell here, another opportunity to buy here, sell here, buy at the low, sell at the top until this breakout happened. Then then you look for a retest, because after a structure is broken, usually there will be a retest before it continues down. So this is a retest, a good area to enter the market, and then continues dropping. So let's check out some candlestick pattern, how they form in the market. You can see the formation of all these candlesticks at this structure. See all these long wicks, they are giving us signal. It shows price rejection in those areas. See this long wick. See how this wick formed. It shows that price has been pushed to this area and rejected. So we see how price struggled around there before this engulfing candle came. What you do now is you register with your broker account, create an account, then download and install MetaTrader 4 on your phone or your laptop. You start by identifying these structural areas: support and resistance, support and resistance. Draw on your trend lines. This is support here, this is a resistance here. And see the same resistance, the structure has been there. Price came here to retest and then it drops. So support and resistance, they are very important tools for trading. This is support here. It's broken over here. And then trend lines also. So create your broker account. The link will be available for you to register your account with Forex Time. It's a trusted broker in Nigeria. So, or you can choose any other broker of your choice. Register and post your setups on the group. Post your analysis, take screenshots of your trade, everything you're doing. Like draw your support and resistance, post it on the group for further assistance. And then don't forget to enroll for the advanced and intermediate classes that will be starting soon. That will help you to advance your knowledge. There is still more to learn and improve your trading system. So thank you.